Asset management partner, Mario Veneroso. And welcome back. It's time for the Word on Wall Street. Top investors watching your money. Joining me right now is Kingsview Asset Management partner, Mario Veneroso, and Infrastructure Capital Advisors CEO and ICAP ETF portfolio manager, Jay Hatfield. Great to see you guys this morning. Thank you so much for being here. Jay, I want to kick things off with you and get your reaction to that big sell-off we saw yesterday and a little bump this morning to the upside. Dow Industrials trying to recover with a gain this morning of 108. The NASDAQ also rallying right now, up 126. But this was after a little bit of a bloodbath yesterday. The Dow tumbling 524 points yesterday at the close, 1.33% lower. That was the worst day since last March after yesterday's January CPI report. Look at the NASDAQ, down 1.8% on the session, 286 points lower as people started to question if the Fed's actually going to deliver on these rate cuts. The Fed now reinforcing its cautious approach to rate cuts this year. And as you can see, we are looking at the 10-year now sitting above 4.2%. Hey, Jay, we're kissing up to 4.3% right now with this move. It's down today, but still up to 4.3%. Your thoughts?
Well, the CPI report was distorted but awful. So there's no acceleration in inflation. Shelter is misreported, and also financial services increased annualized 30%. But the Fed only looks at really PCE core, and they don't adjust it. And our estimate for PCE core is really awful at the end of this month, over 0.5, which means it'll go up year over year. We're rolling off 0.5, but it's going to go up. So we think that the rate cut comes in August and not June, which is very bearish.
So I know you have a bull case and a bear case for all of this. Let's look at the euro this morning. European Central Bank's chief economist, Philip Lane, says that there are risks involved in cutting rates too soon or too late. Jay, so you're talking about the PCE index, which we know is the Federal Reserve's favored inflation reading.
Right.
You're saying it's going to be bad. I want to know what that means. Does that mean we're going to see this selling continue? And look at Europe versus the U.S., because you were the first one who came on this program and said, no. Yeah, the Fed's going to cut, but Europe is going to cut first.
Right. And the bull case for Europe cutting is in place. So the UK inflation rate came in at negative 0.6. So that's 7% annualized versus expectations of negative 0.3. And Eurozone growth last quarter was zero, absolutely zero. So they're stalled. Germany's in a recession. So we absolutely think they're going to cut in June. That'll drive world bond prices higher, rates lower, and be super bullish for the market. In the meantime, we think we'll stall out. And you've seen it even today where tech's rallying, the rest of the market's stalled. And so we'll be sort of stall out in this 5,000 range.
So you think the ECB cuts in June, the Federal Reserve cuts in August, and we're going to get a bad PCE index at the end of this month?
Right, almost certainly. I mean, it's just a calculation, not an estimate.
Should I use that sell-off, if it happens on the PCE, to buy in?
We would be buying the dips. We have a 5,500 target. We probably upgrade that target after the Fed starts cutting. So don't oversell this PCE number.
Well, part of the issue here is these questions that we want answers to in terms of the safety, for example, of the banking sector, valuations in tech. Look at New York Community Bank Corp this morning, Mario, as this Fed rate cut worry could add to the bank's commercial real estate exposure risk. The stock is up 1.33%, but as you know, the dividend was cut. It's been plummeting. The Journal wrote that the regional bank's largest losses are from rent-stabilized apartment buildings in New York City. About $18 billion of the bank loans are backed by the city's rent-stabilized units, representing more than 20% of its total loan book. Mario, when we were in Davos, Howard Lutnick he was with us, and he told us from Cantor Fitzgerald that he sees $700 billion in defaults in commercial real estate coming.
Absolutely. A disaster is an understatement. New York Community Bank just cut their dividends 70%. 20% of their book value is in commercial real estate. Let's look at the economics of commercial real estate. And with yesterday's CPI number of lower interest rates, Tuesday's gone with the wind, as Leonard Skinner says. Cutting rates is gone with the wind. We're lucky to get a cut now in June. If you look at May's numbers, it's under 50%. So what's going on in commercial real estate? And we talked about this last year with troubles brewing in commercial real estate. Now we're paying the piper, Maria. These commercial real estate, the government stepped in and capped rent-stabilized apartments. These buildings are now worth less than they were 5 years ago, which the math doesn't make sense.
Yeah.
And then if you couple that with high inflation, high borrowing cost, you can't make any money.
Yeah.
So the government is supposed to be assuring us, and guess what they're doing, Maria? They're destroying us.
I'm just surprised that we haven't seen a bigger impact already. I mean, now we're talking about layoffs. We've got Instacart announcing it's laying off 7% of jobs, part of a restructuring plan. Yesterday, Paramount Global had a terrible day, announced it's going to cut 800 jobs one day after reporting record Super Bowl ratings. There's more than 30 companies now that are cutting jobs, and I just want to know if, in fact, this is what we have been waiting for. Is this sort of the elements that we're going to continue to see as a result of what the Fed did with higher rates, Jay?
Mm-hmm. We're actually pretty constructive on the employment market. We think there'll be winners and losers, so there's always going to be layoff announcements. But if you look at the 12 post-World War recessions, they all were triggered by layoffs in the construction industry. That's when you have mass layoffs. It goes from, huge employment to very low.
And that was triggered by higher rates.
Right. So but we don't see it this year, this cycle, because of infrastructure spending and a very resilient housing market.
And are you surprised we haven't seen a bigger impact? Real quick.
So if you look what's leading the market, Magnificent Seven, you look at Meta last year, Mark Zuckerberg, year of efficiency.
Yeah.
This is not a new story. It's not a new narrative. These companies are beating more so on their bottom line than their top line because they're cutting their costs. We have a high interest rate environment, high cost, and low growth.
All right, we will leave it there. Mario Veneroso, Jay Hatfield, always a pleasure.